Today we are going to delve into the world of investments. Let's start by discussing one of the most successful investors to date. In fact, in the business world, there are a handful of figures who are universally respected and revered like this man, Warren Buffett. He is commonly referred to as the Oracle of Omaha. Buffett is widely considered to be one of the most successful investors in history. He's also well known for his folksy, down-to-earth persona. Buffett was born in 1930 in Omaha, Nebraska. He began his investing career at a young age, buying his first stock when he was just 11 years old. Over the course of his career, Buffett has been involved in a number of high-profile investments. In 2008, during the height of the financial crisis, he famously bought shares of Goldman Sachs for $5 billion. Buffett's firm, Berkshire Hathaway, made $3.7 billion during the 3 years it owned the shares, of which $1.27 billion came from dividends. Buffett is also known for his philanthropy. He has pledged to give away more than 99% of his fortune to charity. Buffett is a true legend in the world of business. His investment prowess and down-to-earth personality have made him one of the most respected figures in the world. He has shared some of his most important knowledge on what makes a solid investment. One of the best pieces of advice that Warren Buffett has to offer is to invest within your circle of competence. This means that you should only invest in things that you understand and feel confident about. For example, if you don't know anything about the stock market, then you shouldn't be investing in stocks. The reason why this is such good advice is because when you invest in something outside of your comfort zone, you are more likely to make mistakes. And when it comes to investing, even small mistakes can cost you a lot of money. So it's always better to stick with what you know. Of course, this doesn't mean that you can never expand your horizons and learn new things. But when it comes to investing, it's always best to start small and gradually increase your knowledge over time. That way, you can minimize your risk of making costly mistakes and maximize your chances of success. Another important lesson is to remember that when you buy a stock, you are buying a piece of a company. You shouldn't be bothered by short-term share price changes or volatility as a stakeholder in that company, because these are essentially transient noise that long-term investors should disregard. Warren Buffett is often quoted as saying that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that in the short term, share prices are determined by the votes of buyers and sellers in the market. However, in the long term, share prices are determined by the underlying fundamentals of a company. This quote is often used to explain why Warren Buffett is such a successful investor. He focuses on finding companies with strong fundamentals that are trading at a discount to their intrinsic value. By holding these companies for the long term, he allows the market to weigh the underlying fundamentals and eventually drive the share price up to its true value. If you're an investor who is focused on the long term, then this quote from Warren Buffett is a good reminder to stay focused on the underlying fundamentals of a company, rather than the day-to-day fluctuations in the market. There will always be noise in the markets, but if you can stay focused on the long-term prospects of a company, then you'll be well positioned to profit from any market volatility. Purchasing equities with a significant margin of safety is the third criterion. These are investments that are now being sold for a significant discount to their true value. A thorough basic analysis of the company, the industry it operates in, and the effect the economy's overall health has on the company are necessary for accurately evaluating this intrinsic value. There's no such thing as a sure thing when it comes to investing, but there are certain strategies that can help you minimize risk and maximize potential rewards. Let's explore what Buffett means by a margin of safety. Buffett encourages investors to look for companies that are undervalued by the market and have a strong chance of bouncing back. By investing in these companies, he reduces his risk of loss and gives himself a better chance of earning a profit. If you're looking to follow in Buffett's footsteps, here are a few things to keep in mind. 1. Look for companies that are trading below their intrinsic value. 2. Make sure the company has a solid business model and a competitive advantage. 3. Make sure the company has a history of profitability. 4. Make sure the company has a strong balance sheet and ample cash reserves. 5. Be patient and wait for the right opportunity. Following these guidelines can help you find attractively priced stocks with a margin of safety that can lead to long-term success in the stock market. While these observations all seem to be common sense, they are often disregarded. That said, what else should you know before putting your hard-earned money into investments? For starters, understand that significantly wealthy people don't have a secret financial strategy that they adhere to. Instead, they are more likely to know what investing blunders to avoid, how to make money work for them, and when to take smart risks. Here are my top suggestions for avoiding investing blunders. Make your investments more diverse by including an overseas component. Wealthy people understand the need of diversifying their portfolios outside of their local markets. There are a few key reasons why it is important for everyone to diversify their portfolios outside of their local markets. First, by diversifying a portfolio, you are able to spread out risk and potential losses. If all of your assets were concentrated in one market, and that market took a turn for the worse, you could lose everything. By spreading out your assets, you are able to mitigate this risk. Another reason why it is important for you to diversify your portfolio outside of the local markets is because it gives you access to more opportunities. By investing in different markets, you are able to take advantage of different economic conditions and potentially make more money. Lastly, you will be able to hedge against currency risk. If all of your assets were in one currency, and that currency depreciated in value, you would lose money. However, if you have assets in multiple currencies, you can offset any losses from one currency with gains in another. In sum, there are several reasons why it is important for individuals to diversify their portfolios outside of their local markets. By doing so, you are able to spread out your risk, take advantage of more opportunities, and hedge against currency risk. Take South Africa, for example. In South Africa, because there isn't much of a local equities market there compared to marketplaces around the world in more developed nations. Along with being too small, the local equity market does not effectively represent the variety of corporations that a globally diversified portfolio requires. Offshore assets offer some security from unstable local currencies and bad economic policies. Individuals who invest wisely are also aware of the need to establish long-term personal investing goals and then adhering to them. This implies that even when markets experience the inevitable downturn, they stay the course and continue to invest. They see the value of compound interest instead of being enticed to sell their savings to indulge in the newest must-have item. They also don't keep a close eye on the markets or respond emotionally to changes in them. Instead, in order to maximize returns, they cling onto their investments for as long as possible. Avoiding investment fads. High net worth individuals are aware of the risks associated with following fads in investing or dubious social media advice. Instead, they research potential investments carefully before making a choice. People who attain wealth are aware of the importance of having a savings plan and sensible investing. They keep their spending in check, make sure their debt is reasonable, and save enough money. While we strongly discourage you from indulging in current investment fads, let's pause and take a look at some of the popular investment fads throughout history. Tulip mania. In the 1630s, tulip prices in the Dutch Republic soared to unprecedented levels before abruptly crashing, leading to economic ruin for many who had invested heavily in the flower. South Sea bubble. In 1720, shares of the South Sea Company, a British trading company with operations in the South Seas, skyrocketed in value before rapidly collapsing, leaving investors penniless. Railway mania. In the 1840s, investors poured money into railway ventures in Britain, driving up stock prices before many of the companies went bankrupt, wiping out shareholders' investments. Dot-com bubble. In the late 1990s, investors bid up stock prices of internet-based companies to astronomical levels, only to see the bubble burst in 2000, leading to heavy losses for those who had bought into the hype. Take John Doolan. John began investing in the late 1990s, at the height of the dot-com bubble. The market was then experiencing a sharp increase, and tech companies in particular were performing incredibly well due to all the excitement surrounding the potential of the newest technical advancements. When word of a potential merger with the telecom behemoth MCI emerged, John thought he had struck gold when he purchased stock in a firm called WorldCom. The stock price increased when the merger was announced, and John, a young man of 18 at the time, was ecstatic. Sadly, the merger failed, and the stock price decreased. But despite the stock's decline, John continued to buy more of it without attempting to learn more about it. John continued to purchase shares even after the stock's price fell from $40 to $5. When the company filed for bankruptcy when it was revealed that it had been misrepresenting its financial accounts, the stock took a dive. John lost over $6,000 in all. But the event taught him an important lesson: watch out and have a backup plan. While investment fads come and go, they often have disastrous consequences for those who get caught up in the craze and invest heavily without doing their due diligence. Before investing in any new venture, it's important to research the company and the industry carefully to avoid being taken advantage of by fraud or losing your hard-earned money in a risky gamble. Get rid of the emotion. High net worth people are aware of the necessity to keep emotion out of their investment choices. They don't act impulsively, but they also don't invest in businesses whose core fundamentals have altered. They know the value of patience and don't let fear or greed influence their choices. It can be difficult to keep emotion out of your investment choices, but it is important to do so in order to make sound decisions. Here are some tips to help you stay objective. Educate yourself about investing. The more you know about the markets and how they work, the less likely you are to let emotions guide your decisions. Create a written plan. Having a specific plan outlining your investment goals and strategies can help you stay on track and avoid making impulsive decisions. Take Todd Tresidder. He frequently discusses the lessons he took away from his first investment, which resulted in a total loss. He views losses as a normal outcome of investment choices and views them as opportunities to grow. Every bad financial decision teaches us something important, and failing to learn from our mistakes is the real loss. Todd joined Hewlett-Packard shortly after finishing college and was doing well for himself. He heard about a hot new tech company from a friend who worked in the company's credit department. This company purchased numerous HP mainframe computers to conduct its operations. He said that the stock was traded on the NASDAQ pink sheets and that his acquaintance, who worked as a credit analyst for computer supplies, had inside knowledge about the business. Todd, a novice investor, spent all of his cash on the hot stock. The investment suffered a significant loss, as one could anticipate. Todd later recognized that he invested based on a hot tip from a buddy without thoroughly examining the stock, which was a clear mistake. Additionally, he acknowledged that investing more money than he could afford to lose was a grave mistake. The worst part is that he made the investment without a risk management or exit strategy. Stick to your plan. Once you have created a plan, it is important to stick to it. This means buying and selling investments based on your strategy, not on your emotions. Monitor your progress. Keep track of your investment portfolio and how it is performing over time. This will help you see the results of your decisions and make adjustments as needed. Seek professional help. If you are having trouble staying disciplined with your investments, seek out the help of a professional financial advisor. Investing is all about finding the right balance. Don't be too conservative. Investing too conservatively can have a number of consequences. One is that you may not reach your financial goals. For example, if you are investing for retirement and you are too conservative, you may not have enough money to support yourself in retirement. Another consequence is that you may miss out on opportunities for growth. If the market is doing well, and you are invested in low-risk investments, you may not make as much money as you could have if you were more aggressive. Finally, being too conservative can lead to feelings of anxiety and stress. If you are constantly worried about your investments losing value, it can take a toll on your mental health. But don't be too aggressive. Investing too aggressively can be a dangerous move. It can lead to substantial losses in a portfolio, and it can also increase the volatility of returns. When investments are made without proper research or guidance, the risks associated with them can be much higher than anticipated. Investors who take on too much risk may find themselves in over their heads when market conditions change or when unforeseen events happen. This can lead to hasty decisions that result in even greater losses. Many investors choose to work with financial advisors or investment professionals in order to help assess their risk tolerance and make appropriate investment choices. This can help to ensure that portfolios are diversified and that the level of risk is appropriate for the individual investor. Take the story of Joe Campbell. Joe Campbell was a stock day trader who relied solely on the profits from his personal account. Before he made the worst trading mistake of his career and lost everything as well as owing his broker, he was doing reasonably well with his modest account, which had around $37,000 in it. When Colobios, a biotech startup company, revealed it was preparing to wind up, its stock price dropped to $0.97. Joe entered into a short position on the stock when it reached roughly $2.07, fully expecting the price to drop. However, failing to place a stop loss would turn out to be one of his biggest errors. When word spread that an investor group had acquired a majority position in the company, Joe was in a 2-hour meeting. The news sparked intense interest in the stock, and during the after-hours session, the price increased by more than 600%. When he eventually made it back to his desk, his account had a deficit of more than $106,000. He couldn't believe what he was seeing, but only he was to blame. Joe undoubtedly made a lot of errors in his transaction. Even while shorting a stock is risky on its own, doing so without a stop loss and continuing the trade after the market closed that day was a prescription for disaster. Remember, always invest wisely. Learn about the stocks you are interested in. Diversify. Include an overseas component. Create a reasonable plan and stick to it. Avoid fads. Invest without emotion. And finally, find the balance between being too conservative and too aggressive. You can invest wisely.